Nigeria's Exchange Limited or share index closed up 1.1% today at 41,704.11 points. So far in the year 2021, the market's now up 3.56% on the index, has 260 million shares crossed today, traded today at 3.38 billion naira. Joining us to review the market performance so far this year is Fola Abimbola, who is a senior Frontier Analyst with Stanbic IBTC. Fola, good afternoon. Thanks for coming through. How would you describe the NGX so far this year, and what has been the key drivers of the all-share index?
Right. If you want to dissect the performance across sectors, you find out that the oil and gas sector has actually delivered the best returns. And by my calculations, I think it was a 64% appreciation. And this has been driven by the names like Seplat and Total, which are up by almost 80% for Seplat and 50% for Total. We've seen strong oil prices and the passage of the PIA in the last few months, possibly being the catalyst. But more broadly, we are seeing large cap stocks like FBN Holdings and Lafarge. FBN is up almost 49%. Lafarge, Dangote Cement is up 14%. So we've seen large cap stocks like that, driving the exchange. But on the negative side, we are seeing other stocks, large stocks like Nigerian Breweries and MTN delivering not so good returns in terms of share prices. Airtel, for instance, Airtel Africa is down 10%. And, we are seeing all those downsides weighing down on the strong performances of the other stocks.
Interesting. If we break down the performance, how will you describe the last two quarters? If you take out the first part of the year, now we're in the fourth quarter. So if we look between April and September, what do we see?
So if you recall that last year, the pandemic actually started, not the pandemic, but the lockdown and restrictions actually started in late Q1, early Q2. And that was when we started to see that affect all the companies. And then in Q2, what happened was that there was a strong recovery. If you tie that to the GDP, there was a GDP growth of around 5%. You would see that, all the companies listed on the exchange, or most of them, posted some sort of recovery. And that, translated to some up or bullish bias on the stocks. And, so that's actually been the driver of the appreciation between Q2 and Q3. And like I said, in Q3, we had the stronger oil prices. We had, the passage of the PIA, which also drove the oil and gas names, which are also somewhat large cap stocks. And those drove the exchange. Those drove the appreciation on the exchange.
Yeah, so what role are we seeing the PFAs playing towards the market this year as against last year? Have we seen an increased equity investment by the PFAs as against the 2020, which was largely the pandemic year in the main?
Interestingly, my discussions with the PFAs suggest that there isn't that much excitement in coming back to the market, and that's because bond yields have gone back up. In last year, we saw there was a decline in yields across board, and that incentivized an uptake in stocks. But now, because bond yields are expected to go up this year, we are seeing the PFAs take up more bonds and position themselves for better risk-adjusted returns. We know that the PFAs are generally risk-averse and would rather go into the fixed income space. But now that the commercial paper yields, bond yields are going up, that's the incentive to come back to the fixed income market. And that's to the detriment of the equities market. But on the positive side, retail investors and other institutional fund managers are driving some of the performances in the equities market.
Okay, so domestic investors have dominated the activity so far this year. Why has foreign investors remained on the downside in terms of when you look at the ratio?
Right. So the obvious one is the FX, and I think that's the main one actually. A lot of them are sitting on the sidelines, and those who are still in the equities market are looking to actually repatriate their funds and continue to wait until there is a better FX environment. So there's a lot of uncertainties around the FX market, and concerns that if they come into the market, they might not be able to get their monies out. So the strategy for them is to try and see how they will take their monies out and look for other markets like Egypt or Kenya, where the FX regime is more stable, and they could play there. I mean, Nigeria is still an important market to discount or to ignore. However, we would wait and see what the next administration brings in, if there would be a more flexible FX market, or a foreign investor friendly FX market that would see them return to the market.
Fola, quickly, just about a minute. Let's get our bearings right as far as Nigerian breweries is concerned. What's your recent investment note says about Nigerian breweries? What's the tea leaves for this brewing giant?
Right. So the thing is, we actually published a note on the brewery sector a few weeks ago, and our core thesis was that the major lager, which accounts for the larger proportion of the beer market, is no longer appealing to the brewers, and many of them are now investing in more premium markets, like stout, like spirits, like cider, just to capture more margins. We know that the Nigerian consumer is actually has low purchasing power. However, there is still this cross section of consumers that they can tap into to gain more margins, and we've seen their margins decline over the last 5 years. But the strategy now is to invest in more margin accretive categories to grow margins in the future.
Well, let's see how the fourth quarter looks like. We're getting to the holiday season. Do you think excise duty is still a headwind for the breweries?
I mean, excise duties is a risk, not necessarily a headwind, because we've seen consecutive excise increases over the last 3 years. And the consensus from the brewers is that there wouldn't be an excise increase, except for maybe for carbonated soft drinks, which might affect their malt segments. But then the upside is that malt accounts for a smaller part of their revenues. It's lager, stout, and spirits that account for the considerable part of their revenues. But then they would be affected by an increase if carbonated soft drinks excises are increased, which the government has said they would do. So that's the major concern. However, other bigger concerns are still the FX concerns, and then the global supply constraints in the market, which is which is contributing to a higher inflationary environment.
Is that going to be across board?
What's that?
Should that be across board, not just Nigerian breweries, but like international breweries? Is it a different playbook for Guinness, for example?
So it affects all the brewers. So the increase in excise duties for carbonated soft drinks would affect all the brewers, because they all offer some sort of malt brand to the market. But then, we also have the FX headwinds and the global supply chain disruptions, which is affecting the whole industry.
Fola Abimbola, Senior Frontier Analyst at Stanbic IBTC. Thank you so much for your time.